On February 28, war broke out. Markets fell. Many investors panicked and exited. Here is what the data says happened next. From February 27 to the lowest point, all three indices fell approximately 12%. Nifty 50, Nifty Midcap 150, Smallcap 250. The fear was uniform. The selling was broad. Nobody was spared. And then markets began to recover, but not equally. Nifty 50 recovered 10% from its low, but it is still 3% below where it was on February 27. Large cap investors who stayed invested are still slightly underwater from the war starting point. Midcap 150 recovered nearly 20% from its low. It is now 4% above February 27 levels. Small cap 250 recovered nearly 28% from its low. It is now 12.5% above February 27 levels, almost exactly at its 52-week high. Same starting point, same fall, three very different outcomes depending on where you were invested and whether you stayed. Now, here is the behavioral reality. The investor who panicked and exited at the low had to get two decisions right: when to exit and when to re-enter. The market did not send a signal before recovering. It never does. Most who exited are still waiting for clarity that never arrives. Markets can fall again. Monsoon fears, inflation data, a fresh geopolitical shock. There is always a reason to wait. But the investor on the sidelines is not waiting for certainty. Certainty never comes. They are waiting for comfort. And markets do not reward comfort seeking. The recovery was not announced. It happened while most investors were still processing the fear. The fall is always visible. The recovery is always quiet. Timing the exit and re-entry both correctly under pressure is one of the hardest things any investor tries to do, and most fail at it. Panic is a decision. Staying invested is also a decision. For investors with the right time horizon and the right portfolio, the second decision has historically served them better. But it requires process and patience both. Happy investing.